Here's the deal with OSCR Health. This was a very strong quarter. There's really no way around that. Revenue was up big, membership growth was strong, profitability improved dramatically, and the medical loss ratio moved in the right direction. But this is also one of those quarters where investors have to be careful not to take the headline numbers, multiply them by 4, and assume that's the new normal. Because OSCR's Q1 was very profitable, maybe unusually profitable, and that's really the tension in this stock right now. Is OSCR finally proving that it can become a sustainably profitable, technology-enabled health insurance platform? Or was this just a seasonally strong quarter helped by pricing, timing, reserve development, and risk adjustment assumptions? That's what I want to break down in this video. And as always, if you find this helpful, make sure to like the video, subscribe to the channel, and drop a comment below with your view on OSCR, because this is definitely one of the more interesting high-risk, high-reward healthcare names in the market right now. So first, let's talk about what OSCR actually reported. OSCR Health generated $4.65 billion of revenue in Q1 2026, up from $3.05 billion a year ago. So revenue grew a little over 52% year over year. That is not slow growth. For a health insurer, that is a massive jump. Premium revenue was $4.58 billion, which tells you the core insurance business is still the main engine here. But the really eye-catching number was profitability. Net income attributable to OSCR was $679 million, compared with $275.3 million last year. Diluted EPS came in at $2.07, compared with 92 cents last year. Now look at this. The stock was trading around $19.84 after the quarter, up about 10.5% on the day. And I understand why the market reacted positively. OSCR didn't just show growth, it showed growth with better economics. The medical loss ratio improved from 75.4% last year to 70.5% this quarter. In plain English, that means a smaller percentage of premium revenue was being eaten up by medical claims. For an insurer, that is one of the most important numbers on the entire income statement. And OSCR also showed some operating leverage. The SG&A expense ratio improved from 15.8% to 15.2%. Not a huge move in isolation, but when you combine that with rapid membership growth and a much better medical loss ratio, the earnings power starts to look very different. Adjusted EBITDA more than doubled, from $328.8 million to $727.1 million. So yes, this was a strong quarter, but this is where it gets interesting. OSCR's full-year guidance is still calling for operating income of $250 million to $450 million. Q1 operating income alone was $704.1 million. That tells you management does not expect the rest of the year to look like Q1, and that's the part investors really need to understand. This quarter was excellent, but it should not be annualized blindly. If you took Q1 EPS and just multiplied it by 4, you'd get a picture that is way too clean and probably way too optimistic. Healthcare insurance has seasonality. Medical cost trends can change throughout the year, risk adjustment can swing results, utilization can move, and OSCR's own guidance is basically telling you, do not treat this quarter as the new run rate. So I would frame the quarter like this. OSCR showed real progress, but the market still needs proof that this is durable. Now, membership growth was another major positive. OSCR ended Q1 with 3.17 million members, up from 2.04 million a year ago. That's about 56% growth year over year. This matters because OSCR's entire model depends on scale. More members can help spread fixed costs across a larger base. It can improve data advantages. It can make the platform more efficient. It can strengthen OSCR's relevance with brokers, providers, and partners. But fast growth in insurance is a double-edged sword. You want more members, obviously, but you only want profitable members. If the company grows too quickly and misprices the risk, then today's growth can become tomorrow's medical cost problem. That's why I wouldn't just look at membership growth and say, great, thesis confirmed. I'd look at membership growth together with MLR. And this quarter, that combination looked very good. More members, lower medical loss ratio, better profitability. That's exactly what bulls wanted to see. The question is whether that member base continues to perform well as the year goes on. Now let's talk about risk adjustment, because this is one of the most important parts of the OSCR story and also one of the easiest areas for retail investors to underestimate. OSCR recorded risk adjustment transfers that reduced direct policy premiums by $1.44 billion in Q1, compared with $374 million last year. That is a massive number, and management said it took a cautious approach to risk adjustment, while still expecting risk adjustment as a percentage of direct premiums to be around 20% for 2026. Why does this matter? Because risk adjustment can materially affect revenue, margins, and profitability. It is not some tiny accounting footnote. For OSCR, it is central to how the numbers come together. So when I look at the quarter, I like the improvement in profitability, but I also want to be careful. A lot depends on whether those assumptions hold up over the full year. The cash flow number also needs context. Operating cash flow was $2.62 billion compared with $878.5 million last year. On the surface, that looks incredible, but I would not treat that as normalized recurring free cash flow. A lot of it was influenced by working capital and balance sheet movements, including a large increase in payables to CMS. So yes, the cash generation looked very strong. But no, I would not say OSCR suddenly became a cash flow machine based only on this one quarter. That said, the balance sheet is much stronger than it was just a few months ago. Cash and equivalents increased from $2.77 billion at the end of 2025 to $4.81 billion at the end of Q1. Total assets increased to $9.29 billion. Stockholders' equity increased to $1.67 billion. Long-term debt stayed roughly flat at around $431 million. That is a healthier financial position. But again, because this is an insurer, not all of that cash should be viewed as excess capital that can simply be returned to shareholders or used freely. Health insurers carry regulatory obligations, claims liabilities, and CMS-related payables. So, the balance sheet is stronger, but it still needs to be interpreted through an insurance lens. Now, the market reaction was interesting because this quarter was actually a profit beat and a revenue miss. OSCR reported EPS of $2.07, while consensus estimates seem to be closer to around $1.10 to $1.21 depending on the source. So the earnings beat was huge, but revenue of $4.65 billion appears to have missed expectations by about 5%. Normally, a revenue miss can be a problem. But for a health insurer, I don't think revenue alone is the number to obsess over. Margin quality matters more. Medical cost control matters more. Underwriting discipline matters more. If a company grows revenue but underprices risk, that can destroy value. I would rather see slightly lighter revenue with much better medical cost control than a pretty top-line number that hides bad underwriting. So in that sense, I understand why the stock went up. The market cared more about profitability, MLR, SG&A leverage, and reaffirmed guidance than the revenue miss. Now let's zoom out and talk about the business itself. OSCR is not just trying to be another health insurer. The company wants to be a technology-forward, consumer-focused healthcare platform, mainly around individual and family plans, iCareAra Solutions, the Plus OSCR Technology Services business, and now Lucy Health Marketplace. The Lucy launch is interesting. In April 2026, OSCR launched Lucy Health Marketplace, which is positioned as an all-in-one storefront connecting consumers and brokers to major individual market plans, plus ancillary and supplemental products. The reason this matters is that Lucy could expand OSCR's role from just being the insurer to being more of a healthcare marketplace and distribution platform. But I would be careful here. Lucy is strategic optionality right now. It is not yet a proven profit engine. It could become meaningful over time, especially if brokers and employers adopt it. But I wouldn't build the entire valuation case around it today. The core business is still insurance underwriting. That means OSCR has to price correctly, manage medical costs, understand member risk mix, navigate regulation, run efficient networks, and keep administrative costs under control. Technology may help. Better member experience may help, AI and automation may help, but this is still an insurance business with insurance risk, and that's why I would not call OSCR a mature compounder yet. I'd call it a high-growth, improving quality, high-risk healthcare platform. The moat is also still developing. OSCR has strengths in the individual market, consumer-facing product design, and its technology-enabled member experience. But it competes against much larger insurers with stronger balance sheets, more diversified books of business, and deeper provider relationships. So the bull case here is not simply OSCR has technology. The bull case is that technology plus focus plus scale eventually produces structurally better economics in a growing individual healthcare market. That's a much harder thing to prove. Now, valuation. At around $19.84 per share, OSCR had a market cap of roughly $5.14 billion, using 2026 revenue guidance of $18.7 billion to $19 billion. The stock trades at about 0.27 times guided revenue. That looks very cheap if you compare it to software companies, but you should not compare a health insurer's sales multiple to software. Insurance revenue comes with huge claims costs and thin margins, so low price-to-sales multiples are normal. The better question is, what normalized margin can OSCR actually sustain using management's guided operating income range of $250 million to $450 million? The stock trades at roughly 11 to 21 times guided operating income, depending on which end of the range you use. That feels reasonable, but not obviously cheap. I think the valuation works if OSCR can keep growing, maintain disciplined pricing, manage MLR, and eventually settle into durable profitability. But if this year's profitability is mostly a temporary reset benefit, or if medical costs deteriorate again, then the valuation becomes much less attractive. The way I would frame it is this: OSCR is not priced like perfection, but it is priced for proof. The market is giving the company some credit for becoming a real profitable platform, but it still needs to deliver. Now for the 5-year outlook. In the base case, the assumptions are 2026 revenue around $18.85 billion, revenue growing at about 8% annually through 2031, and revenue reaching roughly $27.7 billion. If OSCR gets to a normalized net margin of 2.5%, that would imply around $690 million of net income. With about 370 million diluted shares, that gets you to roughly $1.85 in EPS. Apply an 18 times earnings multiple, and the implied 5-year share price is around $33. From $19.84 today, that's about 67% upside. That is solid. But for a high-risk stock, it is not an insane return. It's attractive if you believe the profitability improvement is durable. It is less attractive if you think the business will remain volatile and heavily exposed to regulatory and medical cost swings. The bull case is much more exciting. If revenue grows at around 12% annually to roughly $33 billion, net margin reaches 3.5%, and the market gives OSCR a 20 times earnings multiple, the stock could get to around $62. That would be more than 200% upside from the current price. That scenario requires a lot to go right. OSCR would need to become a clear winner in the individual and ICHRA market. Membership would need to keep growing without major underwriting mistakes. Lucy would need to become a meaningful distribution engine, and the market would need to start viewing OSCR less like a volatile insurer and more like a scalable healthcare platform. Possible? Yes. Guaranteed? Not even close. The bear case is also very real. If revenue growth slows to around 3%, net margin only reaches 1%, dilution continues, and the market values OSCR at 12 times earnings, the stock could be worth around $7 in 5 years. That's about 65% downside. And that's why this is not a sleepy healthcare stock. This is a high upside, high volatility name where execution really matters. So what should investors watch from here? First, the medical loss ratio. Q1 came in at 70.5%, but full-year guidance implies a much higher MLR of 82.4% to 83.4%. So I want to see how quickly that normalizes. Second, risk adjustment. This is one of the biggest swing factors in the model. Third, membership retention and churn. Growth is great, but only if the members are economically attractive. Fourth, SG&A leverage. If OSCR can keep scaling admin costs efficiently, the long-term margin story gets more believable. Fifth, guidance. If management eventually raises or narrows guidance, that would be meaningful. For now, they reaffirmed, which is confident but still cautious. And finally, Lucy. I don't think investors should overvalue it today, but any signs of real broker adoption, employer usage, or marketplace traction would make the long-term story more interesting. So here's my final view. OSCR Health's Q1 2026 was a very strong quarter. The company showed strong revenue growth, major membership growth, a much better medical loss ratio, improved SG&A leverage, strong reported cash flow, and a much healthier balance sheet. The thesis is improving, but this is not a low-risk bargain. OSCR still needs to prove that Q1 was the beginning of a durable profitability regime, not just a seasonally strong quarter helped by favorable timing and better pricing. At around $19.84, I would call the stock fairly valued to modestly attractive, not screaming cheap, not wildly expensive. The risk-reward is compelling if you are comfortable with volatility and believe OSCR can sustain profitability over the next 5 years. My overall rating would be neutral to bullish. The risk level is high, the confidence level is medium for me. This is a stock where the upside is real, but the proof still has to come quarter by quarter. If OSCR keeps growing members, controls medical costs, manages risk adjustment well, and turns its technology platform into real margin leverage, the stock could work very well over 5 years. But if medical costs move against them, risk adjustment disappoints, regulation changes, or growth comes with bad underwriting, the downside is just as real. So I wouldn't look at OSCR as a safe compounder yet. I'd look at it as an improving high-risk healthcare platform with a much more credible thesis than it had before this quarter. And that's the part I would pay attention to. If you enjoyed this breakdown, make sure to hit the like button, subscribe for more stock analysis, and let me know in the comments how you're thinking about OSCR. Are you buying the profitability inflection, or do you think this quarter is too seasonal to trust?